Okay, so students, how are you? How are you, students? Okay, let us start our next chapter, life cycle costing. What is life cycle costing? Mm, okay, let us start. See, it's the costing technique. Like, obviously, we have done ABC, we have done target costing. Every technique has its own logic. Same here, life cycle costing, it has some unique logic. So let us discuss the story first, then I will tell you what life cycle costing is. Traditionally, like in the back era, we were just calculating just making the yearly accounts. We were just making the yearly accounts. Yearly account means like normal, we are making the sales and cost of sales and then calculating the profit and all that. And in SOFP, just we are making yearly SOFPs, yearly final accounts, yearly final accounts, like income of the year versus expense of the year. Generally, it's a normal rule. Obviously, we have to make the statements every year. It's the normal rule. But what life cycle costing says? Life cycle costing says that don't calculate the data, don't calculate the cost, don't calculate the expenses on yearly basis. You must, what life cycle costing says, you must calculate the cost of that product over its useful complete life, over its complete life. Like this is that life cycle costing tracks and accumulates cost and revenues attributed to the product over its entire useful life. Entire useful life means, for example, let me tell you through the example. For example, I have one product and I know that this product will be in market for 5 years. So 1, 2, 3, 4, and 5 years, right? So what I will do, I will add up all the cost of the over the entire useful life. I'll add all the cost, and what I will do, I will calculate complete cost of life. Complete cost of life. Why? What's the logic behind that? Why I am calculating complete cost of life rather than calculating the cost of every year separately, like we were doing in yearly normal accounts. So why we are calculating complete life? Life cycle says that what you do, that take this complete cost of life and divide it on complete units you will produce over the life. For example, over the complete life 5 years, complete cost is 100,000. I'm just giving the example, 100,000. And you know that over its life we will make 1,000 units and cost will be 100,000. So one unit will cost you $100 per unit. One unit will cost you $100 per unit. Now you know that on an average, one unit will cost you 100 per unit. And if you are selling for more than 100 today, if you are selling for more than 100 today, so obviously over the life you will earn the profit. Over the life you will earn the profit, because obviously we know that cost per unit over the life means complete cost divided by complete units over the entire life is $100, and you are selling it for 120, 130 from today till end. So obviously you are selling more than its cost per unit, you will earn the profit. Okay. So it's written here that life cycle cost of product is total cost of product of entire life divided by number of units of the product over the entire life, like complete units. But why? Again, why? Why we are doing it like this, like complete cost of life and taking complete cost and complete units and then dividing to calculate cost per unit? Why? Actually, what happens? Actually, this is the issue. There is the research that large proportion of cost is incurred at earlier stage. Obviously, like in the start, at the start of the product, life, your cost will be more. You are doing the development, incurring the development cost, research cost, marketing cost, testing cost, like you researching cost on, for example, where the market research basically. So at the start, you need a lot of expenses to be done. but your revenue is not that much higher. Your revenue is not that much higher at start, because obviously you are new to the market. You are new to the market. People are like, on the with the passage of time, they are accepting your product and all the, and they will accept it over the time. Not today on the first day they will take the product from you. So at the start, revenue is not that much, but cost is higher. So that's why at the start of the product life, maybe product is making the loss. Maybe product is making the loss at introduction phase. Maybe the product is making the loss. But over the time, if you notice that the cost you have incurred in the starting years, its benefit you will receive afterwards. Your cost incurred in year one and year two, the benefit of that research, the development, that marketing, that testing, that all market research, that will be received, the benefit received by you will be in year 3, 4, 5, 6, and so on afterwards. So actually, at the start, obviously, if you make the yearly accounts, it will make the loss. It will show you the loss at start. If you make the yearly count separately, like for example, year one, just give me you. Let me give you one example here. Let me give you one example. Year one, two, three, four. Okay. When it's year one, obviously I'm writing here sales and post. For example, you are having incurring a lot of cost 500 and sales are just 400. Obviously, in the at the start, the cost is more market research, distribution, advertisement, marketing, and all that. So you will be having the loss. Okay, next year again, cost 400, revenue 450, loss. But over the time, this cost will decrease, maybe 300, 200, because over the time, you are achieving the economies of scale, you are understanding the market, so you manage to control the cost. But your revenue is now maybe 1000, maybe 1200. Now you are gaining a lot of profit, like 700 and then 1000. So it's the game that with the passage of time, cost gets lower, sales gets higher, your profit is increased. But actually, what happens? The decision making at this point is wrong. Why? What in year one, if any owner, if any company is seeing that our product is making loss, they will be depressed. They will say that maybe we will not succeed in future. Maybe this product is not that viable. Maybe this product will not give us profit over the life. So how we will calculate that? How we will calculate that whether to continue with this product or not? Because in year one it's making loss. So how the one person can take decision about that, that whether we have to invest or we have to make this product or not? Because in year one and two they are facing the loss. So life cycle costing says that don't be worried. Life cycle costing says just make a budget of complete life. See that how much cost is incurring over the life. Here, I know it's not that much easy. Making the budget over the life for the 5 years, obviously there is inflation, tax rates, political issues, economical issues, social issues. Many of the issues are predicted in the future, or maybe not. Maybe you are not predicting the right case scenario. But obviously, making the forecasting, there are proper managers, big level management. Obviously, managers are there for forecasting. So what they do, they make a proper plan that this product is having estimated life, this 4 years, 5 years, 10 years, and almost this cost will be incurred, and they obviously make a plan of number of units and then calculate the average cost per unit, that over the life they will be having this cost per unit. So if it's 100 per unit, then they know that selling it for 120 per unit from today, maybe at the start your cost is not 100 per unit. Maybe it's 500 per unit. Maybe it's 500 or 400 per unit. But 100 is the average cost over the life. So selling your product for more than 100 will give you profit over the life, 100% guarantee. But maybe at the start, your cost is like 300. But I have told you that sell it for 120, 130. No issue. Still, you will be having the loss. But you know that over the life, we are aware of the average cost. Over the life, we are aware of the average cost, and we will cover that. Maybe if today the cost is 300 or 250 per unit, over the life, it will get lower than 100. Like it will be 50 per unit, 30 per unit. That's why average is 100. Because at the start portion, the cost was so high, and afterwards, the cost was so low. The average of both higher and lower cost over the life is 100. So if you are selling it today for 150, 120, more than 100, you will see the loss in the first and second year. Still, you will see that loss. But you know in advance that we will gain the profit. No issue. We will gain a lot of profit, and over the life we'll gain a profit. If we are selling for more than 100, but if anyone is saying that, any manager is saying that sell it for 70, 80, then no. If average cost is 100 and you're selling less than that, you will be having a big loss over the life. So life cycle cost basically it's written. Actually, there is a research that large proportion of cost is incurred at earlier stage, and its benefit is in future years. Benefit in future years, that is advertisement, development, research, project design, programming, prototyping means that when you are inventing, you are making some new product, so you make the model for that first, 1 to 2 units, 3 units, 10 units, just to check that how it will work. And equipment acquisition, at the start you have to acquire a lot of equipments, obviously a lot of capital expenditure. So life cycle helps in even distribution each year, every year. So life cycle help you, so for the even distribution, actually it's not actually even, but life cycle helps you to calculate average cost over the life. So you know that your average cost is this, and you must not sell under this cost, under this average cost. You have to sell more than that average cost. Okay. Like, for example, this is a question that, yes. This is very important question. This is very important question. You will understand properly. You will understand the complete concept of life cycle in this question. I will do obviously, but you will understand the complete entire logic of this question. My students, wake up, wake up. You don't need to sleep. You don't need to sleep. Focus on the topic. Focus on the point. If you're focusing is on this question properly, I guarantee you life cycle costing, you will having a great concept in your mind, and you in exam it will not like be difficult for you, right? So let us start. It's written the following details relate to the new product that has finished the development and is about to be launched. Development finished, launch 1 year. Basically, it's 1 year for the product to launch, then growth year, then maturity, then decline. So the complete life of the product is 4 years. Complete life of the product is 4 years. Complete life for the product is 4 years. Okay. Now, at the start, if you see on the development R&D, it's 20. Obviously, at the start, it's 20. Okay. After that, marketing cost 5, the million is common. 4 million, 3 million, 0.9 million. Production cost, it's written production cost per unit. Okay. And number of units also given. Now, there is a main point here. The launch price is proving a continuous issue between managers. Actually, this is complete cost. This is the complete cost, right? This is the complete cost, and the launch price. Basically, these are the cost scenarios. But for the launch price, at which price we have to sell, is proving a contentious issue between managers. The marketing manager is keen to start with a low price of $8. Marketing manager is saying that sell it for $8 to gain new buyers and achieve target market share. The accountant is concerned that this does not cover during the launch. This does not cover the cost during the launch phase, and has produced the following schedules to support this. Marketing managers did. He calculated the first year cost only, and it comes 11 per unit. 11 per unit. How he have done this? Just leave it. How he have done that? Basically, he have done the working from here, obviously for the first year, but leave it. No need to see the working. Just understand the concept that the accountant has calculated first year cost per unit. In the first year, calculated the cost per unit, and it comes how much? 11. Listen, if the cost is 11 today, according to first year, so obviously business will say, the manager will say that sell it for more than 11. But the market manager is saying that sell it for 8. Because if you want to gain the market share, mean you want to enter the market, you want to gain the customer, so you sell for 8. Now there is a conflict that he is saying $8 should be the selling price, and the manager accountant is saying that it should be more than 11 because 11 is cost. 11 is cost, so he's saying more than 11 should be the selling price. In that case, we'll make the profit. Both are, we'll see whether it's correct or wrong. But accountant, for now, it seems he's true that obviously he's saying 11 is a cost, sell it for more. But marketing manager saying sell it for 8. Now we have what we have to do. This concept of 11 per unit, it's according to yearly basis account. He has only calculated first year calculation and told you the cost per unit. Now here life cycle costing comes. Life cycle costing says just calculate entire life cost per unit and see what is that. If it's, for example, 100, sell it for more than 100. So we'll calculate the life cycle costing. Now the concept of life cycle costing is that total cost of product of complete entire life, complete life of complete life divided by total units of products of complete life. Okay. Let us see the complete cost. No issue. Complete cost. Complete cost means complete cost. Means obviously some student what they do, they don't add the development because development is before the launch phase. They don't add the development cost. No, every single cost you are seeing in the question, you have to add it. Complete cost means if here it's written R&D cost 20 million, you will write here 20 million. 20 million plus 5430.9. Marketing, add a complete cost. Miss nothing. Either you are seeing the cost that is like written in paragraph afterwards, that there is a cost that is not mentioned in the format. Add that as well. The entire cost should be added. Plus 5 plus 4 plus 3 plus 0.9. Okay. Plus now these production costs also given, but these are obviously per unit. These all costs are per unit. So let us calculate complete total cost, because these costs are not per unit. Marketing cost was total, and this cost was per unit. This cost was per unit. This cost is per unit. So just multiply with units. 1 million into 1, it will be 1 million. 5 million into 0.9, 4.5, sorry, 4.5 million. 10 into 0.8, 8 million. 4 into 0.5, 2 million. So this we have got the production cost over the useful life. Plus 1 million plus 4.5 million plus 8 million plus 2 million. We have added all the costs. 8 million plus 2 million. I have not written M or million here. Just you know that it's million. Okay. So I have added all the costs. Have I left any cost? See, complete question. Is there any other cost? I've written here all the costs. If there is there any other cost in the question? No. Obviously, we have to add everything, and I've added every cost, and I've added. Divided by total units. Let us see what are the total units. Yes, it's given. These are the total units. 1 million, 5 million, 10 million, 4 million. These are the units. So 1 plus 5 plus 10 plus 4. Let us add all of that. 20 plus 5 plus 4 plus 3 plus 0.9 plus 1 plus 4.5 plus 8 plus 2. 48.4 is the complete cost divided by units. 1 plus 5 plus 10 plus 4. It's 20. 20 units we will make over the 20 million units. So 48.4 million divided by 20 million. It's $2.42 per unit, your average cost over the life. The product will cost you actually in average over the life 2.42 per unit. So if you are selling for more than 2.42, you will earn the profit over the year. I know in the first year the cost was 11. I know, but it was according to year on year basis. It is not the complete entire life cost. According to first year calculation, our cost was so much higher. Obviously, it will be marketing and all that cost will be higher. See, if you see here, see here, see. Marketing cost at start 5 million, at last year 0.9. A lot of difference. At start 1 production cost, at last 0.5. Obviously at start the cost is higher. You are entering the market, you have to show you have to show off your everything, marketing and all that, meeting with the market agencies, meeting with the, like, obviously like nowadays social media marketing is so much, so you have to invest a lot of money on that. So at start cost is higher. I know cost is higher. Accordingly, first year cost was 11. But when we calculate the cost over entire life cost per unit, that is life cycle cost per unit, that is 2.42. Now I am okay. If I am selling it for more than 2.42 from today till end, more than 2.42 till end, it will be okay. It will be okay. I will gain the profit. My pockets will be filled with the money, with the profit. Why? Because I am selling more than 2.42. So here, marketing manager said that if you will sell for 8, you can gain the market share, like you can gain the customer easily. So it's very good that selling for 8, which goes the product which goes to 2.42 is very good. So we will say that marketing manager is saying correct. In this, there is a lot of difference. 2.42 and 8, a lot of difference. By the way, actually, when you make the statement of first year, year one, selling price will be 8, cost per unit will be 11. I know. First year, you will be seeing the loss. Actually, you will be saying the loss for first year because cost is 11. But over the life, on an average, you will get the profit because this cost will not be 11 for all the years. It will get from 11 to, I think so, 1 point something, to 1 point something, because obviously if average is 2.42, it's 11 and 11, and here the cost will decrease to 1 point something or 0 point something. The average is basically 2.42. So if you are selling it for 8, actually the loss will be shown, but at the end of the life, you will see your pocket, you will see the profit, there will be the profit. There will be the profit. This is how the life cycle costing works. This is how it helps you. Clear? Okay. Now, we have to study some theoretical concepts of life cycle costing, some theoretical point of life cycle costing. We have to discuss some theoretical points of life cycle costing, my beautiful students. Be be attentive, be attentive, wake up. I know F5, any type of teaching, any type of study, obviously student sleeps and all that. No, don't do that. Focus. Your eyes, your ear, your eyes should be working properly during my lecture, right? Let us continue. Let us continue. So next theoretical point. Actually, this complete discussion is now on the life of the product. Most product have a distinct product life cycle. Obviously, actually your product has proper life cycle phases. It's not like when your product is launching, it's being like the father of the market. No, at the start it takes time. So every stage we have to understand. So first stage of any product is the product development phase. Product development phase. This phase is known as development phase. This phase, this phase is known as development stage. In the development, if you see the lines, these lines, the upward line was for the sale and downward for the profit, and this is the point zero. Okay, with the passage of time, obviously when the time was zero, you are on the development phase. If you see till here where there is a development phase, if you see the sales are zero, the sales line is zero, because obviously on development state you are developing the things, you are researching and development and all the testing, prototyping and all the designs, equipment testing. You will not be having any revenue, you will not be having any sales, so sales is zero. If the sales is zero, so obviously you will not make the profit. Till this point you will make the loss, till this point, because it's under the zero line, so you are making the loss at this phase. So every product, when it started and it's in development phase, obviously it incurs the loss. Okay, after that, second phase is introduction phase. Second stage is introduction stage. This is also known as market development and launch phase. Market development and launch phase. Introduction phase is also known as market development and launch phase, in which your product is just being introduced to market. in this phase you are having the sales being increased, if you see, but not that much, like that much. The just obviously market, the stage, the basically your the life is started, and obviously customer are just going to accepting slow by slow your product. Wait a minute. Okay, so introduction phase. If you see, I'm saying that sales are increasing, but still you are making loss. But still you are making loss. If you see, you still are making loss. You're not making the profit. You still are making the loss. Okay, but after that, when your product is being recognized by the customers, they are like okay with your product, they are like giving the good feedback. Now the next phase is growth phase. Next phase is growth phase. Wait. Okay, so guys, we were discussing about growth phase. So what is growth phase? This is the phase where market is going to recognize you more, and at this stage obviously you are like gaining the market share very instantly, very fastly. So that's why if you see your sales are like increasing upward, and the inclinement is too much upward that you are like growing on daily basis, daily on the monthly basis your sales are growing dramatically. But obviously you have to incur the cost as well. The cost is also increasing, so that's why your profit is increasing. Your profit is also increasing with the debt, but cost is also increasing. Why your cost is increasing at this point? Because obviously you have to incur on marketing, you have to incur on the retention of your business, the retention of the customer. So you have to incur the cost. But at this phase, market is knowing you like properly. You are growing and you are having the market capture, market share very soon. So this is the phase, that is a third phase of the obviously product. The first two is like demotivating. Demotivating means like challenging. But at this phase, you are okay that sales and profits are going upward easily. After that, after that phase, it comes maturity phase. Maturity phase is the top level of the product phase, like at which the sales are on the top level, the profits are on the top level. But at this phase, obviously your sales and your profit becomes normally still. Like if you are earning $100 profit, so almost $100, $100, $100,000, 100,000, 101 triple zero or 102 triple zero 99,000. Like it's like on an average stable sales, stable profit. But maturity phase is the phase on which you want that obviously no one wants to get the decline stage, or no one wants to exit the market like intentionally. Everyone wants that they should be in the market for a long time, earn a more profit. So obviously you do proper steps, proper take the steps to be in the market. So you want to increase the maturity phase as much as you can. But after the maturity phase, obviously, if the product is like ended and now your market has been ended, so there is at last the declining phase or a revitalization phase. So it's declining phase on which your sales comes downward, and your profits gets downwards, and at last you are like out of the market. So actually, if you see that I'm not saying that every product has this life cycle. Maybe some product has a maturity phase from like 100 years, but this life cycle costing rule applies where the life is short term. Actually, life cycle costing you can't do for, obviously there is a company Coca-Cola. It's like from more than 100 years, or maybe in future maybe more than 100 years. So the company with a lot of for the centuries they are doing business. So for that, life cycle costing will not work. Life cycle costing calculation will work obviously for the short term, like there where there is a change in the models, like iPhone. One model comes, and after that another model comes, so they know that over the entire life 3 years we are having one model that we have launched. So obviously for that 3 years, if you say the market is like you will be having the course of market is accepting that product, and after that you give the new model, you launch the new model. So for that, life cycle costing is there, because model on model, obviously they are coming and you do the life cycle costing, and they have the product market growth, maturity, and then declining, and then next model and all that. So this is somehow the product life cycle works, and actually this is the phases of life cycle. This is the complete as I have discussed all the points, it's written here. As I have discussed the points, just take the screenshot, of it, and must read it. Must read it. These are all the points I've discussed now. When I like obviously told you about the topic at starting phase, what happens at launch phase? I've told you that marketing and promotion goes, then growth stage, then maturity, then decline phase. Just read it. Take the screenshot, read it. Must, right? It will help you in MCQs. Okay, now we have next topic, that maximize the return of product using some factors. Obviously, when there is a product life, like for example, 3 years, 4 years, now there is a big challenge for you that you have to maximize the return of the product. You have to maximize the return of the product. Why? Obviously, you want to earn profit. Simple. Everyone doing the business has the intention of earning the profit. So this is somehow the maximizing the return of product using some factors is first factor. First factor that is written is design cost out of product. See, 90% of cost is of design and development. Obviously, at the starting phase, you have to incur a lot of cost on design and development. So the lot proportion is of the design. So if you are at this phase at design, you are incurring a design cost. So what you have to do, is you must integrate the design team with the production team. See, design team should work in cross function with the production team to minimize cost. How? See, the design team is making some designs, right? And production manager is not seeing it, right? And design team is working individually and then sending the model to production that you have to make that. After that, production manager says that, oh, we can't make this design, it will cost us a lot, it will require skilled labor, it's a lot of cost, and market will not accept that much selling price will charge. So obviously, design team, if they work with production team, they will obviously plan. If design team is making some complex designs, production team will obviously say that no, don't do that, will obviously not able to make this type of design in that lower cost, because the lower the cost will be higher the profit, obviously. So that's why design team, if they work with in the cross function with production team, they will make the effective designs that is not difficult for production team to produce in a specific cost per unit. So actually, to minimize the cost, design team obviously should work in the with the production team to minimize the cost. So this is written that new cost effective production processes and changes in components. If obviously there is any change in component that is lowering the cost of the business, obviously production team should say design team that lower it, make that design that take lower cost, less cost, so that we earn the more profit. So this is one of the way that the product design is very much important. So design team should work with production team to make the return higher, to make the return maximized, right? After that, second point is minimize the time to market. This is another approach to increase the returns. How it will increase? See, minimize the time to market means that if you think you have any idea, just apply it, start it. If you have an investment, you have an idea, start it. Because in this competitive environment, obviously everyone is thinking a lot. Everyone is going to invent something new and new. So maybe you have some idea, you discussed it with your friends, and you are like, I will start after 2 3 years. And within 2 3 years, you have told your friend he has an investment and he started that plan without you. Now, after 2 3 years, he is the king of the market, and you are just saying, oh, why I have told the plan to him. No, don't do that. Don't do that. If you feel anyone have investment, any friend has investment, collaborate with him, partner with him to implement your plan. So as soon as possible, you are entering the market. Obviously, you will earn a lot. Obviously, you have a plan. Maybe other people also have a plan. Just start it. Maybe you are like in market for 2 years, 3 years, and after that, new competitors arrive the market. So obviously, you will obviously earn a lot till that 3 years, because you were the leader, like at the start. After that, when competitor will come, obviously you would have earned a lot of profit in first 3 years, because you were only the inventor of that product. So that's why in the competitive environment, launch new product as soon as possible. If you do that, obviously you will earn a lot of return that will maximize your return, obviously. And third point is minimize the break-even point. You know, break-even point is what is break-even point. In the basic lectures we have discussed, break-even point is at the point at which you convert from loss. You basically have a loss and you convert to profit, at what your loss is recovered and now your loss is zero, and now you are shifting towards profit. Obviously, every business, when they are doing nothing, they are making the loss. They have the rent, electricity, and all that. They are obviously doing the operations. They have the cost. So you have to sell something to first recover the loss and then reach the break-even point where loss is recovered, loss is zero, profit is zero. And after that, when you sell more products, you earn the profit. So at start, 100 units, 200 units, you are on the loss and you are recovering the loss on every unit you are selling. But once, for example, at 200 units, your loss is recovered. Loss is zero now. Now, selling the units above 200 will give you profit. So that 200 point is break even. So the minimize, the less the break even point is, like the lower the break even point is, like you can, if you can achieve the break even point fastly, obviously you will convert it to profit more fastly. See, it shouldn't minimize the break even point. As soon as possible, the profit is achieved. It's good. So you must minimize your break-even point. Means you must recover your loss as soon as possible. Make the strategies for that. How can we recover the loss as soon as possible? So that once we have recovered the loss, obviously now we will earn the profit, eat the profit, will enjoy, right? So as soon as possible, the profit is achieved, it's good, right? So in it, obviously pricing strategy also matters. Pricing strategy also matters. Like if you are having good pricing strategy, your customer will be more. Like if you want that your product is, you want to gain the market share, or you want to enter the market more fastly, just make your product at low price. Just sell your product at low price. And if you want, like you have a high quality image, just sell your product at high price. If you feel like you want to earn fastly and your product is not that much of high quality, not that much of that everyone is not dying for your product, then don't sell it for higher price. No one will take. They're not dying for you. Then in that case, sell the product at lower price, so that everyone is like, okay, that's a lower price, I can take that product, just try it. And if they feel like it's good, they'll come again and again. They will be loyal with your product. But on the other hand, if you have a high quality image product, go for high price. So this is the strategy. The strategy is the good, you will convert to profit, you will achieve the break-even point more fast, right? And you will obviously, if reaching break-even point more fast, you will earn the profit. It's one way of obviously maximizing the return. After that, maximize the length of life cycle itself. You know, as we have told that life cycle, everyone wants that life cycle of their product is longer, so that they can earn more, they can more be in the market. So long life means good profits. Long life mean good profits. So everyone want that their product life cycle is maximized. So if you maximize the length of life cycle itself, obviously you can maximize the return of the product. So that's the last point, maximize the length of life cycle itself. It's written like explore new markets. Like if you feel like you have so you are going to sell some product, if you think that you are going to sell some product, now you are selling in, for example, Pakistan. Now you are selling, for example, in, wait a minute. Okay. Now you are selling in, for example, Pakistan. Now you think that this product will be appreciated in Africa. So go there, sell there. If you are going to sell your product in other countries, your market will, obviously your life cycle of the product will increase, because it's still customers available that are obviously purchasing your product. After that, minimize the time to market. As we have discussed here, if you will minimize the time to market, as soon as possible we are entering the market, the more time we will be getting for our product's life cycle, because we are at the first we are entering the market. So obviously the more time, when the market will end, you are the first that enters the market, so your product's life cycle will be longer than others competitor life cycle of the product, right? Make new models. You feel like iPhone, like feel, if iPhone, any model of the iPhone, they feel like, okay, the people are being bored. Okay, so we were discussing the new models. New models, for example, as iPhone. iPhone is making the new models on the regular basis. The reason behind that is to increase the life cycle. People will get bored with the same model. So increasing launching the new model mean that obviously the iPhone company is increasing the life cycle. Just in the cars, just changing the lights and making the new model is increasing the life cycle of the product. Like this are all points are like maximizing the life of the product, because obviously the more the life is, the more return the company can earn on the product. So it was all about life cycle costing. It was all about life cycle costing that we have already learned. So till here, the basic life cycle costing is completed. Just we have a small portion, a small calculation, and the benefits of life cycle costing we'll discuss in the next lecture. So till then, take care. Meet you guys in the next lecture. Allah Hafiz.